it's been holding up well, and who better than Gautam Duggad, MD, Head of Sales Institutional Equities at Motilal Oswal Financial Services, right here in the studios to talk about where he feels the market is headed next and what his latest note has to say about the markets. Gautam, welcome to the ETNA studios.
Thank you.
Good to have you in person here. Gautam, I was just looking at the screen and thinking in my head that what a long way we've come off from the March lows, right?
Yeah.
What do you think is working and what do you think is still left to be conquered?
So, Aisha, thanks for having me here. There are two or three things which are helping the markets. I think some moderation in the geopolitical hostilities, which has brought the crude down to manageable levels now. Second, I think the fatigue in the global AI trade, which had like everyone talking only about Korea and Taiwan. Wherever I have done recent global roadshows in Hong Kong, Singapore, even Europe, people were just on and on about Korea and Taiwan, and India had become like a bit of a pariah, right? So, I mean, it's good that we are also making a comeback to an extent. But the most important thing, Aisha, which is helping at the margin is the corporate earnings. The corporate earnings season is turning out far, far better than expectations. Not just the aggregates, but even the spread of the earnings, the number of sectors, the beat to miss ratio. First time we are seeing an earnings upgrade after a very long time. And then, of course, the high frequency data points that you've seen, the auto monthly, which is coming yesterday, GST data, credit growth is almost in the 19% handle. So whatever actions the government has taken over the last 9 months, I think the reduction in income tax rate, the GST cuts, the interest rate cuts that we have seen, cumulatively, all of that is helping at the margin. And this is happening despite the monsoon still being, 15, 16% deficit. And last but not the least, the last 2 years of consolidation / time correction, especially in the benchmark indices, has also made valuation a little more palatable versus where we were at 23, 24 times in September 24. Today at Nifty, we are at about 18.8 to 19.1. And EPS is holding on at about 14, 15% growth. So if this earnings continues like this and expectations remain intact for September, October, I think there is more upside to be had. We have to be far more constructive on market today, purely because the underlying earnings are looking very, very strong.
So I want to pick up on your SWOT analysis one by one, and let's first talk about earnings. Because they've grown about 2% on a year-on-year basis. You were anticipating a dip of about almost 10%.
Yeah.
Would you say this is a genuine beat, or would you say this is largely an OMC-driven beat?
So I'll look at numbers. Let's for the discussion,
Sure.
keep OMCs out. Okay, if you keep OMCs out for the 211 companies which have declared numbers till Sunday, you take 3 out, which is 208. For them, we were expecting 13% earnings growth. The actual earnings are 17%. Similarly, for midcaps, if you exclude HPCL, the earnings is about 25% higher, which is like a big number, 25% higher earnings this year, this quarter. Now you go back to small caps, about 90 small caps in our coverage of declared numbers. For them, the earnings are up close to 32%, right? Now, this is a quarter. If you look at on an annual basis, last 2 years, Nifty has done absolutely nothing. FY24 EPS was 1,000 rupees, FY26 was 1,065. So cumulatively, you got 6% earnings growth in 2 years. And market also gave you 5% return. The March 2024 Nifty market cap was 181 lakh crore. March 26 was 192 lakh crore. So whatever earnings growth you got, the equivalent market returns you got. But in this 2-year period, for example, in FY26, if you just look at the latest year, Nifty earnings were of 5%. And that was the story that India mein earnings growth nahi hai. But if you looked at Nifty 500, earnings grew 15%. My coverage universe of 380 stocks had delivered 15% earnings growth in FY26. More importantly, within that, the midcaps, and we cover a fairly large number of midcaps, almost 105 out of 150. So for those 105 midcaps, the earnings growth was 24% last year. The only sour point for last 3 years was small cap earnings, which have compounded just at about 10%. So what was 63,000 crores of earnings for small caps in our coverage for 180 companies? In FY23, it ended at 83,000 crores. So 10% CAGR on a 3-year basis. Now, on that base, next 2 years, we are expecting 30% growth. So far, the first quarter, we have not seen any earnings cut. In fact, we have seen a marginal upgrade. So for my entire coverage universe, we have seen about 1.8% earnings upgrade for FY27. That sounds like music to the ears. Second, the number of companies beating estimates and meeting expectations cumulatively are 78% of the coverage universe. So only about 22% of the earnings companies have disappointed or have missed the expectations. Number of companies where earnings have been upgraded divided by number of companies where earnings have been cut is 1.7 times. This ratio was below 1 for a very long period of time. So early signs of an earnings revival, and more importantly and hearteningly, your top line growth is in a handle of 17-18%, which is highest since December 2022. So a bit of an inflation making a comeback is also helping, because last 2 years, your nominal GDP was 8.5, 8.9%. This year, we are expecting about 13% nominal GDP growth. So 14-15% earnings growth for benchmark indices looks doable for next 2 years, but the real fun is outside Nifty. As I was chatting with Sajid.
I was just going to come to that, I think the proof is in the numbers, because if you look at the March recovery, or rather recovery from the March lows, it's your mid and small caps which has outperformed. Will that play out in earnings? Or shall I say continue to play out in earnings as well? And will the Nifty earnings as well as the Nifty performance, will it continue to lag the broader markets?
I think so, because look, growth is what is predominantly deciding the direction of the market and valuation, and as it should rightly decide. So like I said, last year my mid-cap earnings grew 24%. If you exclude OMC, last year earnings growth for mid-cap was 20%. This year on that 20% base, again we are expecting 19% growth. So fairly solid set of numbers. For Nifty, we are expecting a 13-14% earnings growth this year, EPS of I think 12.25. Now, within a 20% broad index earnings growth or my coverage universe earnings growth, you will always find 10, 15, 20 mid-cap ideas where growth is upwards of 30%. Similarly, small cap, whatever allocation increase you have seen in small cap portfolios in the last 2 months, it's happening because the earnings trajectory is changing now. On a base of 10%, 30% is doable, because you have many sectors within small cap always look at bottoms up, because sectoral, doesn't give you too much of insights. So you have a very low base of financials in small cap. Some of the other sectors are also having a low base. So I think the action is going to be outside of Nifty. Having said that, Nifty is looking reasonably priced, right? But, if we look at this data as a percentage of total market cap in India today, let's say if 100 is the market cap, the contribution of large cap is at a 2-decade low. The large caps are accounting for only 59 to 59.5% of total market cap of India, right? Now, if I have to play devil's advocate, I can always say that mid caps and small caps are already looking very expensive, because the mid cap index is 28 times or 27 times. And small cap is close to 23, 24 times, whereas large cap, which is Nifty, about 18.5 to 19.5. So valuations is in favor of large caps, but growth is in favor of mid and small cap. And India is a growth market. If you've seen the trajectory of companies which have delivered 20, 25% earnings growth over the years, you've seen that, this might sound like a very flippant statement, but there is no cap on PE for companies that are growing upwards of 25%. And there is no floor on PE for companies which are disappointing and growing below 10%. So you have to pick your spots and, then hope that whatever earnings you're building in, the companies go and deliver that.
Financials, that's the biggest pocket in the large cap space. Then there's metals as well, where there's some cyclicality. Both of those have been outperformers in this quarter. At least on the financial side, would you say that earnings will likely sustain, just given the growth which you've just spoken about? And on metals, is this kind of run rate sustainable in terms of earnings growth?
So let's take financials, because that's a bigger chunk of the earnings. If I look at for this quarter, total 59 financials have already declared numbers. I was looking at the data yesterday. Out of 59 companies, 57 have either beaten or met expectations. 34 have beaten, 23 have met. There are only 2 companies which missed expectation. One is Bank of Baroda, because of some one-off provision hit that they took.
Yes.
And the other is ICICI Lombard. Again, some adjustment they had to make.
Yes.
So financials, even at the time of preview, which we released a month back, we had called out NBFC as the sector of the quarter, right? NBFC lending. Now, NBFC lending, if I look at the 21 companies that we have in coverage, they have delivered 36% growth versus expectation of 28%. And the spread of earnings is, touchwood, the best that I have seen in NBFCs in the recent times. If you look at the non-lenders, which is basically the capital market, virtually every company has beaten expectations. We cover, so far 14 have declared numbers, 12 have beaten expectations. Across the range, AMCs, brokers, wealth managers, I don't think exchanges have declared the numbers yet, but whatever numbers have come, they have been better than expectations. And now come to the bigger elephant, which is the banks. In private banks, purely looking at numbers doesn't help because there are a lot of internals which has disappointed the market, be it NIMs or in some cases credit quality and all. But if you purely look at the PAT number, out of 12 banks which have declared in the private side, almost 9 have beaten expectations.
Correct.
But our preference, even today we are underweight private sector banks. We are more bullish on PSU and more importantly, the diversified lenders. So if you look at my model portfolio, the overweight on diversified lenders is massive. So we have NBFC lenders in the form of Shriram Finance. Recently, we upgraded Bajaj Finance as Bajaj Finserv. We also like L&T Finance. We have brokers like BSE in the model portfolio. Brokers like Grow, then exchanges like BSE, AMCs like HDFC AMC. So I think the real excitement in financials over the next 3 to 5 years will be outside of banks. And that is the, I would say, template in every big cohort in India. In consumption, if you've been playing staples, you would have underperformed on a last 5, 7, 10-year basis. Correct. The real excitement was on discretionary. We bet our weight on consumer staples 0 a year and a half back, and we have not yet restored. Similarly, in technology, the excitement has been on the new age side. In healthcare, if you had looked at the traditional 5 large pharma generic companies, I was just chatting with Sajid, the top 5 large pharma companies of India, on a last 10-year basis, between FY16 to 26, the cumulative earnings CAGR is 7%, and the market cap CAGR is 8%. But a lot of wealth was created in pharma and healthcare. Where was that wealth created? Very niche segments which are growing, which is CDMOs, hospitals, diagnostics. And that is pretty much the case across all the big 5 cohorts of India, whether it is financials, tech, consumption, industrials, or healthcare. So you have to align your portfolio with the changing times today. Nifty today, unfortunately, is not representing that. I mean, if you do bottoms up on Nifty, out of the top 50 Nifty companies, 25 to 27 are just not growing. Or maybe they're growing in 5-7% band, which market doesn't like.
Correct. And what about metals, Gautam? Curious to know how the view there shapes up.
So metals, surprisingly, if whatever estimates we've had this year, this quarter obviously is far better than expectations, but in metals, things change very fast. So you have to always mark to market the underlying commodity prices. Now, if this year's expectations are delivered, it will be the first time in the last 10-15 years that metals will have 3 consecutive years of positive earnings growth. They've already delivered good growth in FY25, then FY26, and FY27 is also looking like the numbers will be upwards of 20% growth. Like within that, we obviously have our choices on the ferrous side, non-ferrous side, but as a cohort, metals earnings are looking pretty solid.
So coming back to Nifty, Gautam, from the views that you've given, private banks, IT, staples, unfortunately, these are large, matured sectors with very high weightage on the index. Would you say that the Nifty will continue to stay sort of suppressed because of the weightage of these sectors?
The way Nifty is composition, Aisha, today, that is going to be the case.
It's almost like an old economy index now.
You don't have, unfortunately or fortunately, because we've not seen too much of churn in Nifty. The representation of sectors hasn't changed meaningfully. Even today, you have financials at about 37-38%, And companies which are there in Nifty, obviously they've done really well. That's why they're in Nifty, right? But the kind of churn that one would see in mid-cap index or small-cap index, we've obviously not seen because they're supposed to be more stable part of the portfolio. What I would look at is, typically if you look at the last 10, 15, 20-year data points, you would find that Nifty has usually compounded at nominal GDP plus minus 1-2% growth. So if your nominal GDP has grown at 10-11%, Nifty has given you 12 to 13% return. That, I think, equation is not going to change. But within the Nifty, there is a lot of dispersion, both in terms of earnings and stock price returns. Case in point being last year, calendar year 25, Nifty would have given you 9 or 10% return. But the best performing stock in Nifty, which was Shriram Finance, gave you 76% return. And the worst performing stock last year was Trend, which was down 35%. So plus 76 to 35 in an index which has given you 10% return. So even within Nifty, there are money-making opportunities. You just need to, put your head down and see where things are changing, where the growth visibility is strong, and where you are seeing, companies which are partaking in the opportunities which are evolving. For example, consumption. consumer companies, specifically if you divide it in two buckets, staples and discretionary. Staples, I think, bearing few, and they are also belonging to the food sector. But in the HPC segment, we have not really seen much of activity on the ground. Forget the market cap, forget the earnings, forget the stock price returns. If you look at their portfolios, they've barely changed. 10 years back, if you see the presentation of those companies, and every company puts a slide of products in their portfolio, they've not changed much. Today, the talk is all about D2C. The distribution has changed, product has changed, the premiumization game has changed. I mean, look at discretionary. You're a company. I mean, this is factual public data, so no recommendation. And we have done this in our portfolio last year. Exact 1 year back, when we published our 1Q FY26 preview, we made FMCG zero. It was underweight for 5 years. We made it zero July 2025. We removed Hindustan Lever, replaced it with Radico. Both were coincidentally around same price band, 2200, 2300. 1 year later, Radico is 4200 because the earnings growth has been upwards of 40%. And next 2 years is also looking at 30%. HUL is down 5-6% from those levels. Forget, I mean, this is just one company example. There are many examples in same sector. Look at liquor itself. 10 years back, Radico was, I think, 2 or 3,000 crore market cap. United Spirits, I remember, was 36,000 crore market cap. From that 2,000 crore, today Radico is 55,000 crore market cap. And United Spirits from 36 is about 1 lakh crore. So one has given you 3x return, other has given you almost 25-30 times return. So clearly market is becoming more and more discriminatory. Plus, look at the big picture view. You had 10 years of zero interest rates. So even a 5-10% earnings growth attracted 30, 40, 50, 60, 70 Ps also. Today you are looking at 10-year yields in US which are approaching almost 4.7, 4.8%. So market may not be as benign with the kind of multiples it offered you when global interest rates were zero. So today the 10% earnings growth or a 5% earnings growth may end up attracting 30, 35 P instead of 60 P. I'm just throwing a random number in there, but the interest rate environment has changed and the cycle has turned post-COVID. Till 2020, I remember, between 2010 to 2020, I think there were only 3 sectors which were growing in our coverage universe. Private banks, IT, and consumer. These 3 sectors used to account for, in 2010, I remember, 22% of our profit pool. In 2020, they became exact 45%. They were growing at 10-12%, but because other sectors, commodities, global cyclicals, domestic cyclicals, they were declining. PSU banks went through the whole 5-6 years of asset quality cycle. Capital goods went nowhere. Suddenly in 2020, the cycle changed. A lot of these domestic, global cyclicals and commodities made a huge comeback. So the contribution of these 3 sectors, which went up from 22 to 45% in 10 years, is now back at about 25-26%. And the rest of the sectors have taken the mantle on. Now, it can change.
How do you, Gautam, make your peace with the multiples within mid and small caps? Do you hunt for bottom-up stories while you can get the larger structural stories right?
Yeah, and see, there is no escaping away from bottom-up stock picking. Right. Second, you have to understand.
I mean, you can't buy a Radico now.
See, there are 2 factors that decide. One is your time horizon. What is your time horizon? It's very critical in mid and small caps because you're buying at 25, 27 P, not at 10 or 12 P, which was the case back in 2013. Your mid and small cap indices had come down to 10, 12, 13 P, 12 or 13 P, if I remember well, during the taper tantrum episode. Today, given the dearth of growth opportunities in the large caps, people are hunting in mid and small caps. Second technical factor, last 2 years, we've seen massive FI selling. Last year's number was, I think, $19 billion. This year, first 7 months, close to $28, $29 billion. Now, FIs typically have 73 to 75% of their holding in the top 100 companies. So if they're selling, obviously, their selling will concentrate in the large cap. So private banks have not done badly on a fundamental basis. It's because they're facing extra selling pressure. Now, and on the contrary, you're getting inflows in the domestic funds. So this year already we have seen, I think, we are approaching close to $60-70 billion. So, and you have only 150 midcaps. So if midcap funds are receiving inflows, that money will rotate in those 150 midcaps. So till the time this situation doesn't correct itself, either you see a moderation in FIS flows or broad basing of the definition of midcap, you will see this valuation problem there. And then how do you deal with it? Either you extend your time horizon or B, you become even more granular in your stock picking. So when you are paying 30, 40 P to any stock in mid cap, small cap, you have to be absolutely sure you will still end up making mistakes. But as long as you have done your homework, as long as you have done your bottom-up stock picking, met the management, done your channel checks and whatever, then you leave it to the destiny. But bottoms up is what I think will define the next 1 to 2 years, given the way earnings are positioned right now.
Very less opportunities bottom up now within mid-cap.
No, I won't say that. I would think that there are enough and more opportunities to be had across sectors. It's just that from a short-term point of view, if one is getting into mid-cap, small caps now to make a quick buck, he or she will be disappointed on a 3 to 6 months basis. But you look at the returns on a 3-year, 5-year basis, trailing also, I think, and we had done this data across indices, Nifty, Nifty 100, 150, NSE 500 and NSE 250 small cap. It's a beautiful data on a 3, 5, 7-year basis. You just plot the earnings for all these 5 indices and you plot their stock price return or index return. They by and large converge, barring for one time period for one index. So market has been extremely fair in rewarding companies where earnings are coming and equally brutal in punishing companies where earnings have been disappointing.
But in terms of sectors, Gautam, just to kind of close this, wrap this conversation, you've given us great filters, right? Sub 10% growth versus 20% plus growth and the like. Are there sectors, more top down, where this could likely be a trend which could play out maybe next 12 to 24 months, where growth will likely come in and multiples aren't as inflated, or the opportunity size is very large?
So clearly, I think select pockets in auto, right? Like we've had a preference for M&M and TVS for last 4 years now. We've removed Maruti from our model portfolio back in July 2022. We've not added it yet because the growth differential is massive. You go to consumer discretionary, there's sub-segments, jewelry, hotels, aviation. You can have your, and nowadays a lot of this new age companies which we've added in the portfolio, Lenskart, Misho, Grow, right? Then you go to capital markets, NBFC that we just discussed. Even in industrials, if you're sticking around with the old benchmark names, possibility of beating market is slightly low. But if you had been fortunate enough to invest in power transformers, defense at the right time, I'm not recommending them now, but if you had them in the portfolio, you would have still outperformed. Healthcare we discussed. So in every pockets, in every cohort, there are sub-segments of opportunities where growth is going to be very strong and market will be tolerant of those high PE multiples as long as that growth keeps coming. You look at Divi's Laboratories, it's not a cheap stock by any stretch of imagination.
75 times earnings.
But the last 2 months,
79 as we speak.
last 3-4 months, earnings have come through. We've upgraded earnings today again by 11%. So, I mean, market is giving you a very strong message and signal. It is for the investor to, assimilate that.
Okay, Gautam, great
Thank
having
you.
you in the studios.
Pleasure.
Could go on chatting. We should plan a longer chat for sure next time.